Are you looking to invest in Australian property but feel overwhelmed by all the news headlines about interest rates, inflation, and the economy? You are not alone. These big picture factors have a huge impact on your property's value and investment returns. But what if you could understand them, predict their impact, and use them to your advantage? That's exactly what we are tackling today at Prime Pace Properties. In this episode, we are diving deep into the economic indicators you absolutely must track to make smart, profitable property investment decisions here in Australia. Stick around because we are not just telling you what they are, but how they affect your wallet and what you can do about it. Welcome back to the Prime Pace Properties educational series, where we empower you with the knowledge to build a thriving property portfolio. I'm Kuldeep, and if you are serious about mastering property investment in Australia, make sure to hit that subscribe button and the notification bell so you don't miss any of our upcoming episodes. Last time, we touched on building your core investment strategy. Today, we are zooming out to the national and state level because no property exists in a vacuum. The broader economic climate directly influences buyers' demand, rental yields, and ultimately your capital growth. So let's break down the most critical economic indicators you need to be watching. First up, and probably the one you hear about most, are interest rates, specifically the RBA cash rate. This is the big one. The Reserve Bank of Australia sets this rate and it impacts pretty much every loan in the country, from home mortgages to business loans. Think of it like this: when RBA raises the cash rate, banks usually follow suit. Increasing mortgage interest rates, what does that mean for you as an investor? Higher borrowing cost. Your loan repayments go up, impacting your cash flow. Reduced buyer borrowing capacity. This can cool down the property market, potentially slowing capital growth as people can borrow less and pay less. Impact on rental yields. If holding cost increases but rents don't keep pace, your net rental yield can shrink. But it's not all doom and gloom. Lower interest rates have the opposite effect, making borrowing cheaper, stimulating demand, and often fueling price growth. The key is understanding the cycle and how it influences your buying and holding power. Pro tip: always stress test your investment budget against a few percentage points higher than the current interest rates. This helps you prepare for potential rate hikes and ensures your investment remains sustainable. Next, let's talk about inflation and consumer price index, or CPI. Inflation is essentially the rate at which the general level of prices for goods and service is rising, and consequently the purchasing power of currency is falling. CPI is the measure we use for it. High inflation means your dollar buys less over time. For property, this has a few angles. Building cost. Inflation can drive up the cost of construction, materials, and labor, impacting renovation budgets or the cost of new build. Interest rate link. High inflation often prompts the RBA to raise interest rates to cool the economy, bringing us back to our previous point. Rental yield. In some cases, strong inflation can lead to higher rental growth as landlords pass on the increased cost, but it's not a direct, immediate correlation. Understanding inflation helps you anticipate potential cost increases and the RBA's next move. It's like having a crystal ball for your expenses. Now, let's connect people to the economy, wage growth, and the unemployment rate. These two are massive indicators of the health of the economy and, by extension, the property market. When wage growth is strong and the unemployment rate is low, it means more people have jobs and more money in their pockets. What does this mean for property? Increased demand. More disposable income means more people can afford to buy property, boosting demands and prices. Rental market strength. With stable employment, tenants are more likely to pay rent on time, and demand for rentals remain high, supporting rental growth and low vacancy rates. Mortgage repayment ability. A strong job market reduces the risk of mortgage defaults, which is good for the overall stability of the property market. Conversely, High unemployment and stagnant wages can lead to a weaker market, less demand, and potential rental areas. These indicators tell you a lot about the confidence and capacity of the average Aussie to engage with the property market. Now, while we talk about national economic indicators, it's crucial to remember that Australia's property market isn't one monolithic entity. It's a collection of many different markets. And a key driver for their individual performance is economic growth by state or region. Think about it. A booming mining sector in Western Australia, a significant infrastructure projects in Queensland, or a strong financial service industry in New South Wales. These regional economic drivers create jobs, attract population, and ultimately fuel demand for housing. Job creation and population magnet. Strong economic growth in a state or region means more businesses are thriving, creating more jobs. More jobs attract more people from interstate and overseas, leading to increased population growth. And what happens when more people need a place to live? Demand for both rentals and purchases goes up. Local spending power. When a region's economy is strong, wages often increase and consumer confidence is higher. This means people have more money to spend and critically more capacity to pay rent or services a mortgage. Infrastructure investment. States with robust economy activity are often able to fund and attract more infrastructure development, which further enhances an area's appeal and property values. This is why you often hear about Perth's market surging while Melbourne might be more subdued, or a regional city in Queensland outperforming its capital. Each state and major region essentially has its own economic heartbeat. As an investor, understanding these regional nuances is paramount to identifying where the next growth hotspots might be, or where there's sustained demand that underpins your investment. Pro tip: don't just look at national averages, always dig into the economic reports for the specific state or region you are considering. Look for indicators of diverse industry growth, major project pipelines, and consistent job creation. And speaking of states, their governments also play a direct role, often through specific programs. Which brings us to our next point: government grants, incentives, and foreign investment regulations. Our fourth key area, and is often overlooked by new investors. Governments, both federal and state, use grants and incentives to stimulate specific parts of the market. Think about the first home owner grant. While aimed at owner occupiers, it can indirectly reduce supply in the rental market if more people buy rather than rent, and it generally indicates government support for housing. Always keep an eye on these, as they can create pockets of increased demand or specific opportunities. Then there are foreign investment regulations set by FIRB, the Foreign Investment Review Board. Changes here can significantly impact demand for certain type of property, particularly in capital cities and new developments. Stricter rules can reduce foreign buyer activity while easing them can increase it. This directly affects who's buying and how much they are willing to pay, so it's vital to stay informed. Beyond the big headlines, there are two more powerful indicators that give us a pulse on average Aussie's financial health and willingness to engage with the property market: household debt levels and consumer sentiment index. Let's start with the household debt levels. Australia has notoriously high levels of household debt, primarily driven by mortgages. While property values have often risen to offset this, high debt level means households are more sensitive to changes in interest rates and economic shocks. What does this mean for property investor? Risk assessment. High household debt can indicate a potentially vulnerability in the market. If interest rates rise rapidly or unemployment climbs, a significant portion of the population could face financial stress, potentially leading to distress sales or reduced demand. Borrowing capacity. When overall household debt is high, lenders might become more conscious, tightening lending criteria. This can impact your ability to secure finance even if your personal finances are strong. Consumption impact. Heavy debt repayments leave less disposable income for general consumption. which can impact the broader economy and indirectly people's ability to save for deposits or pay higher rents. It's a nonce indicator. High debt can mean a confident market, but it also signals a need for a prudence and careful risk management. You want to see debt levels that are manageable relative to income. Finally, we have the Consumer Sentiment Index. This is basically a survey that gauges how confident consumers are about their current and future financial situations, job prospects, and overall economy. It's a measure of collective mood, and that mood can significantly influence property decisions. Why is this important for you? Buying and selling confidence. When consumer sentiment is high, people feel more secure about their jobs and finances. They are more likely to take on big commitments like buying a home or investment property, which drives demand and prices. Conversely, low sentiment can lead to people holding back, reducing transaction volumes. Rental demand. Confident consumers are more likely to move from new households and potentially choose to rent if buying is perceived as too expensive or uncertain. Forward looking indicator. Sentiment indices often move before other economic data. Remember, sentiment indices often move before other economic data. A sustained decline in consumer sentiment can be an early warning sign of a slowdown in consumer spending and eventually a cooler property market. It's like the market's gut feeling. Pro tip: look for trends in both household debt and consumer sentiment. A sharp rise in debt combined with falling sentiment could signal a market under stress, whereas stable debt and rising sentiment suggest a healthy environment for property investment. So, there you have it, a powerful overview of how economic indicators like interest rates, inflation, wage growth, unemployment, and government policies are constantly shaping the Australian property landscape. Understanding these isn't about predicting the future with 100% accuracy, but about making informed decisions and mitigating risks. Remember, property investment is a marathon, not a sprint, and staying informed is your competitive edge. And if you found this video valuable, please give it a thumbs up. It really helps us reach more aspiring investors like you. And if you haven't already, subscribe to Prime Based Properties for more in depth insights into building your Australian property wealth. What economic indicator do you watch most closely for your property investments? Let us know in the comments below. We love hearing from our community and sparking discussions. Next time, we are moving from the macro to the micro, diving into location and demographics, arguably one of the most critical pillars for pinpointing high growth areas. You won't want to miss that one. Until then, happy investing, and we'll see you in the next episode.